Over the last couple of months, it seems like you can't turn on the news, open up social media, or talk to a friend without hearing about tariffs. This is also the most common topic we've been discussing in client meetings lately. While the question comes in many forms, today I want to discuss what impact tariffs may have on your investment portfolio and what we are doing to protect our clients from them. Hi, I'm Chad Butnery, Wealth Advisor with the Andrews Group at Asante Capital Management. With this topic being so publicized in the media over the last several weeks, I'm not going to spend a lot of time here detailing why they are used and the economic theory behind them. For the sake of this video, I'll be relatively brief on the background. A tariff is simply a tax paid by the importer of a good to their own government. Tariffs are protectionist measures intended to discourage companies from importing goods and incentivizing them to purchase goods made in their own country. So, what's the problem with the tariff? Well, early on in economics, you learn that trading with other countries is typically beneficial for all parties. It often makes sense to focus on what you do well and export that to other countries rather than trying to produce everything in your own country. Tariffs can create problems with the availability of goods and/or cause inflation. While the tariff is technically paid by the importing company, that tax is almost always passed down to the consumer. Prices of goods often increase, and this can cause financial challenges for households. This could also impact people's jobs and create uncertainty around business. For example, a company might rethink investing a large amount of capital to build a plant in a country if they don't know the cost of doing so. Okay, now that we've briefly explained how tariffs work, the question becomes what, if anything, can you or should you do from a personal investment perspective? I believe the single most important thing you can do is diversify broadly. It is very difficult to know how these policies will impact individual companies and markets in general. Rather than trying to predict that, you'd be much better off owning a portfolio that is well diversified in the first place. Our clients own portfolios that contain over 13,000 individual holdings, with no one company making up more than 1.8% of that. This doesn't mean that you can avoid market volatility, but we feel it's a pretty good long-term strategy to protect your capital. Secondly, we believe it is extremely important to have an investment plan in place. During one's lifetime, we know there are going to be bumps in the road. In fact, over the course of 30 or 40 years, there will be many. This time it's tariffs, next time it will be something else. I'm not stating this to trivialize the impact of something as serious as tariffs on the economy. Rather, I want to emphasize how important it is to be prepared for whatever comes in the future. We work hard with our clients to create a plan that's right for them. By customizing each client's asset mix and creating a portfolio that matches both their risk tolerance and capacity, we take our duty of advising clients through times like this very seriously. We strongly believe that adhering to your well thought out investment plan and being disciplined is very important, especially in times of uncertainty. While going through market volatility and uncertainty is never fun, it's important to remember that this is exactly why we expect to earn more with stocks than bonds or cash in the first place. We know that there's going to be more risk associated with stocks than with cash or bonds. As a result, investors expect to earn a premium on their money to hold these assets. Take COVID, for example. We saw extreme market volatility during that time. Yet, if we look back over that period, an investor would have been much better off holding stocks and adhering to their plan rather than moving into safe assets at that time. Finally, I think it's important to remember that while something like tariffs can impact economic growth, it is only one piece of the puzzle when it comes to stock prices and could have a relatively subdued effect on market prices over the long run. For example, look at the relationship between the US and China over Donald Trump's first term in office. Beginning in 2018, the US began imposing tariffs on China on a range of products. Retaliatory measures were implemented, and trade negotiations were ongoing over the next couple of years. Ultimately, an agreement was reached while initial tariffs remained in effect. Despite this uncertainty, both the US and China posted better stock returns than the world market index, ex-US, over this same period. While some of the initial tariff threats have been implemented, I think it's fair to say that this is still a very fluid situation. We don't know which tariffs will stick and which ones may be able to be avoided. Who knows, this could all change a week or a month from now at the rate we're currently going. With that said, it's important not to minimize the impact these tariffs could have. After all, they will cause challenges to certain industries and the people who work in them. But you should take some comfort in remembering that you have a well thought out investment strategy that is extremely well diversified and a plan that is customized to you and your goals. I find it often helps to remind ourselves of this when we're feeling uneasy or experiencing market volatility. Unless something changes with you on a personal level, we highly recommend sticking with your plan in times like these. I'm Chad Butnary with Asante Capital Management. Thanks for watching. As always, if you'd like to have a conversation on how you or your personal situation may be impacted by these policies, please give us a call. We're always here to help.